have the S&P below its 100-day moving average. What kind of weakness then can we expect technically?
You know, it looks like we're going to stay in this minimal range, and probably 1385 would be the next leg down. But, you know, like you guys just said, we've been in such a narrow range, but that's broadly across the board. And basically, like you said, nobody wants to dip their toes in until something, whether it's good, bad, something comes out here. The longer and longer the waiting game goes on with the fiscal cliff, I think the less volume, and volume is atrocious right now, but the less volume we're going to see. But what's very interesting, take a note, with the market flatlined here pretty much, we're seeing the VIX actually up quite a bit off its lows from a week or so ago. So we're trading almost up towards 17, which you know, over the last month, 2 months, that's actually a high point with the exception of the one blip that we had. So just take a close watch to that. Maybe that's some sort of indicator.
It may indeed be, and that's, of course, the short term. Meanwhile, Michael Cuggino, you run $17 billion. You're the founder of Pacific Heights Asset Management. You've been in business a long time with a very steady strategy. Walk us through your long-term positioning right now.
Well, long-term positioning, I mean, we're cautiously optimistic on equities in the belief that we think that there's a lot of pent-up growth potential in the U.S. economy, and if the right structural levers are pushed, taxation, fiscal policy, spending, etc., then that could unleash very good, solid growth going forward that would not only propel the U.S. but also help out the world's economy. But that's a very big if right now, and I think this is one instance where technical chart analysis is lining up with fundamental analysis. There's a lot of uncertainty. There's both sides on the fiscal cliff and budget issues are marketing their positions aggressively. I don't see any real resolution at this point. I think everybody understands it would be in the economy's best interest to get something done. But it's not only getting something done, it's getting the right thing done, because what we're talking about is a structural issue for the next several years here.
Right,
so we want to get it right.
So, Michael, if you want to get it right when you're dealing with the markets in this uncertain environment, where are you putting your cash right now?
Well, we advocate a diversified approach in our permanent portfolio fund, so we're spreading it around in commodities and precious metals to guard against the fear factor, safety trade, hyperinflation, those sorts of issues. We're also in bonds to protect against a slowdown, a recession or worse, a liquidity crisis, that sort of thing. And we're also in equities for growth, for gradually rising inflation, for prosperous activity, which we hope occurs. So we're spread out. On the stock area, we're definitely more weighted towards growth stocks, more higher beta, volatility stocks that we would expect to outperform in a good, aggressive growth environment. We've got our defensive positions to handle the negative. So we're pretty spread out right now.